Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to review the idea of segregation of income and how it relates to velocity banking. So if you've never heard of velocity banking, never studied it at all, watched the video, go ahead and click our link below to Velocity Banking 101. It'll give you a great foundation to let you know what the concept's about. And then you could come back here and we could go over the idea or the topic of segregation of income. Now, before we even get to that, I'm just going to do a quick commentary about it's not about how much money you make, but it's after a certain income level, it's about how you manage your cash flow, right? And so I did a quick Google search on doctors who live paycheck to paycheck. I have plenty of doctors in my family, and I know that they make pretty good income, right? But there's a good portion, and I'm not saying all, but according to this blog, there's a good portion of people who are doctors that spend a lot of money and live paycheck to paycheck, right? Why many doctors live paycheck to paycheck? 1,000 shares, and this is from 2019. So I'm not going to go into the article in debt, but basically, there's a lot of doctors who make a decent amount of chunk change, and they don't feel it. They don't feel it. You know, I I kind of see how it's possible to make a lot of money and just feel like you're going broke. And when I heard that concept the first time, and this is when I was completely broke because I was low income, I was like, how is it possible, especially when in my low income mind, how is it possible someone to make high income and be broke? That makes no sense to me. But if you understand the concept of segregation of income, totally understandable, right? So I'm just going to demonstrate the concept of segregation of income right here. So let's say you get paid, right? You get paid and you're a doctor, high income earner, and what happens? Your money goes to your checking account and then it gets split all the, many ways up the wazoo. Maybe you'll put some of it in savings, money market, 401k. You put that money into 401k. Yeah, it's got some good tax treatment that might be beneficial to you. Talk to your accountant. But it might have some good tax treatment, but that money's locked away until you're 59 and a half at least. And then you have to pull that money before you're age 70 and a half. And I think the penalty, there's a penalty for using that money before 59 and a half. And if you don't withdraw before 70 and a half, I think you pay like 15% taxes. I don't know. I got to look that up. But you lock it up, that money's locked up. And I know a couple of people who are like so into investing with the retirement accounts because they love the tax treatment and status and all that. But I'm not going to go too into that right now. But my point is that you get your money into your checking account. It gets split up many places up the wazoo. Savings, money market account, 401k. Maybe you have a couple of credit cards, credit card one here, two, student loan, auto loan, mortgage. I mean, think about the difference between, let's say, a low income person and a higher income person. Say you're a doctor, instead of your student loan being $30,000, it's going to be like 300 or $200,000, right? Your mortgage for it's not going to be for a $200,000 home. It's going to be something a little bit nicer, like a $600,000 home. So you can see how easy it is for someone who's even a high income earner to live paycheck to paycheck, right? So your money comes in, and then it just gets split into many different places. One, two, three, four, five, six, seven, eight, right? So eight different places. And when your money is segregated, it's just not going to work as well as if it's just all in one place. So the idea of velocity banking is that all your money is going to go into one place called your line of credit. And if you don't know what a line of credit is, all it is a financial tool that allows you to borrow money, pay back, and it leaves it allow you to borrow again. So a credit card is kind of like a line of credit, but it doesn't have the name line of credit. And there's also other types of lines of credit, like personal lines of credit, business lines of credit, home equity line of credit. But basically, you borrow money, you pay it back, and then you could easily reborrow again. Really easy, right? So here's the thing. I'm not going to go over everything about velocity banking, but usually you have to have a budget. It's also explained in our velocity banking 101 video. Click the link below if you want to take a look at that. But my point is that I'm just doing a much more simplified version of what we saw here. But even here, our income is split into way too many places, right? So we got two loans and that are eating up our cash flow. So one loan is $400 that I can never really use again to student loan. Thanks for putting me into debt college. Another one is a $600 loan for a car payment. That's like the average, I think. I think the average student loan payment is like 400 and 600, right? And so it's like, okay, how do we put all our money into one place that's so it's much more effective for us? What we do is we just do a simple debt transfer, right? So instead of being in this situation where you, and I know I'm the other example is a little bit more simplified, where you're splitting your money into so many places, what you're going to do is just put your paycheck into one place, which is your line of credit, right? So this is, and I'll show you what I mean by that. So let's get rid of these loans. So I have a $25,000 limit on my line of credit. So think of it as like a $25,000 credit card. I'm just going to transfer my student loan and car loan into here. And guess what? It's $23,000 balance, right? But look at what happened. This gets eliminated, right? So this is gone. So this is zero. This is zero. Our paycheck's still the same, $5,000. But what happened? We only now have the rent and the other stuff. Whoopsie. Let me copy and paste. So our expenses, they used to be $3,000 and they're only $2,000, right? And the savings, we're not going to have any savings. We're not going to have any savings. What we're going to do is put our entire paycheck into the line of credit, take out our expenses accordingly, and then we're going to have a cash flow of $3,000. And so our balance is going to go down every single time, $3,000 every single month, pretty much, right? So it's kind of like we generated $1,000 out of thin air. And the reason why it's so easy is because we're not having our income segregated, let's say in this example, two different spots, right? It's all just here. Our income is applied, our entire income is applied to one place, which is the line of credit. And look how fast we pay it off, right? So all we have to do is take the previous month's balance, which is H2, and minus it by the cash flow, which is $3,000. So we see this $3,000, that's where we get our cash flow of when we apply our paycheck and take out our expenses accordingly. And let's see how long it takes, right? So we'll say this is month 0, 1, 2, 3, 4, 5, 6, 7. So it really just took us about 7 months to pay off these two loans. Now, your average American does not pay off 23,000, so 10,000 here and 13,000 here. Let me just refresh this because sometimes Excel on the web goes a little wonky. But 10,000 and 13,000 in under 1 year. Who does that? But why is it possible? Because we don't segregate our income, right? We're putting our entire paycheck into one place. We're trying to gather our expenses into one place, including our loans if it's possible. And our cash flow will be used to, quote, velocitize or break down or eliminate the loan in record time. I mean, do you know anybody who's able to pay $23,000 off without really changing their lifestyle just by doing a simple debt transfer and putting your entire paycheck, right? So this is why most people are broke, because of the effect of segregation of income. They got their income split into way too many places: checking, savings, money market, 401k, credit card, student loan, auto loan, mortgage. And if you don't pay these off quickly, all it is just interest, 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 interest. And if you've never done any sort of study about how banks make money, they actually love low payments. They'll make more money with lower payments on a 30-year mortgage than a higher payment with a 15-year mortgage, right? They love low payments because they love collecting interest. And what happens is that if you just make the low payments, you're going to be broke and you won't know why, because of segregation of income. Your income split into too many places. All right. So this is Korean Atlanta Mentorship. If you have any questions, leave them below. If you're interested in joining our group, go ahead and click the Google form link below, or you can email us by clicking the About section of the YouTube channel, find out our email, send us an inquiry, say, hey, I'm interested in joining, and we'll go from there. All right. Have a great day, everybody, and we will speak soon.